So in not only in equity markets, in general, we can view the landscape of the strategies in this two dimension. One is the underlying trading view that you want to express, or as the popular term is used now, the risk factor that you are trying to capture. And the second is the investment or the trading style. For example, if you're a technical trader, or if you're a quant-oriented trader, or you're a fundamental trader. So based on this, I have divided most of the common trading strategies in this few segments. So for example, on the fundamental side, if you are trading based on momentum or trending, it's typically a factor-based investing, where you based on fundamental factors and as well as the price data, you figure out the underlying momentum risk factor, and then you try to take a view on that. On the other hand, if you're using the same idea expressing in terms of technical trading, you typically use indicators like moving averages, or if you're a charting guy, you'll be using continuation chart patterns. So for example, it's a megaphone, or it's a triangle. Or if you're a quant fund, then you'll be approaching it slightly differently. You'll try to first identify the type of the momentum factor that you have there, whether it's a time series based momentum factor or it's a cross-sectional momentum factor. That means whether you want to trade a single underlying over a period of time, or you want to capture the momentum across a cross-section at any given point in time. And you'll devise your trade strategies based on that. Similarly, for mean reversion trades, for example, technical traders typically go for the swing trades or the retracement patterns or the pivot trading types. And the most famous fundamental strategies like value investing is basically a mean reversion trade. Stock has become very cheap compared to its fundamental value. So you assume that it will return to its fundamental value, so you buy it. It's basically a mean reversion trade. On the other hand, if you're a quant fund, that becomes a pair trading for you, or most of the statistical arbitrage is in fact kind of a mean reversion trade. Similarly, the breakout trades for technical trader, it will be opening range breakout, dual thirst, or pattern-based breakout. For fundamental, it will be more like a relative value strategies. For quant, it will be advanced model like regime switching models or hidden markup models. And similarly, a very important part is a very important risk factor is carry. Carry is the risk factor. I believe that most of us understand this trending or the mean reversion or the breakout kind of moves in the underlying. Carry is something that the risk factor where you make profit or loss when nothing changes, just time pass. And typically, the carry strategies in technical traders handbook is executed through selling vol, typical short gamma strategies based on if you identify a particular underlying is range based, so it will not break out, so you sell vol and you basically collect the theta. Similarly, in the quant funds, all the basic tenets of the high frequency market making is based on this. They are basically trying to catch the difference between bid and offer. And similarly, for fundamental, it is usually the cross-country and the cross-asset relative value. So typical example is the FX carry trade, where you borrow in a cheap currency and lend in an expensive currency. For example, borrow in Japanese yen or euro, or lend in, say, INR or dollar even. And finally, the event-based risk factor, which is typically implemented in the quant circle based on news-based automated trading, and the fundamental, it is usually fully discretionary. And honestly, to be honest, there is nothing equivalent in the technical traders handbook.